Good afternoon, everyone across Asia and different times of the day if you are elsewhere. What I wanted to cover today is very much the what and the why of factor investing, and then Felix will get into the how. So once we know the what and the why and what we're looking for, it's a lot easier to be able to sort of separate real factors from those imaginary factors that probably won't generate performance out of sample. So getting back to the foundations of factor investing, these not only include sort of the multi-factor indices that we're familiar with, but also the new type of factors such as ESG factors and also unpriced factors, or otherwise known as sort of risk factors and risk models. As Susan said, there has been a focus more recently around innovation or creating new factors. The things about new factors is if they come at the cost of consistency, you end up with very poor out of sample and live performance. So we'll talk today about academic state of the art and what makes a good factor. So empirical evidence on factor investing started about 30 years ago. Everyone's familiar. If you're in the factor space with Farmer and French in 1993, that really showed portfolios that were built with high book value and small size did better than those securities that had low book value and large size. That was followed up by Carhart in 1997 that showed high momentum stocks did well. And then quite a few years later, both Farmer and French and Hao Zhu and Jane came out with more profitability, high profitability and low investment factor. So they were much more investment-based factors. And over the last 5 years or so, we've had a good run of articles that have bedded these 5 factors down as what we call workhorse factor models. When we are looking at any possible new factor, we should be considering their addition to the investing universe over and above these base factors. We've got a lot of out of sample performance for these guys now. So we're actually able to judge new factors in addition to what they bring to the party in addition to these 5 factors. So what are these? Value. I always sort of explicitly talk about value to be book value. This is not fundamental value. This is not buying something cheap. It's high book value stocks. And we do this by sorting portfolios into high book value versus low book value. You invest in the high book value, you anti-invest or avoid the low book value securities. And we'll see in the Farmer French article 2015, they produced a good outperformance of 4.5% per annum with a T-stat of 3.2. I won't go through all the details for the rest of them, but I'll just highlight the definitions for those that haven't come across them. Momentum is stocks that have performed well over the last 12 months, omitting the last month. Size, stocks with low market cap, they're small stocks, small companies. Profitability, stocks with high either return on equity or gross profitability as an example. Low investment, so they're companies that have had low changes in their total assets. They haven't been investing much in their additional firms over time. And then low risk. Low risk are companies that have low idiosyncratic risk or low beta, low volatility. Each of those in the literature has produced well and also continued to perform out of sample. Why are we interested in having quite a few different factors? Well, it seems these different portfolios deliver returns in different ways at different times. So what you'll see here is the very long time horizons across different regions. The US is the longest, of course, so we've got 50 years there. Developed Europe, Japan, a little bit shorter, and Australian emerging markets, 20, maybe sort of 17 years. But across all of those different time horizons, a portfolio that is diversified across these multiple factors would have done well as the factors themselves across multiple regions would have done well. So diversification across multi-factor portfolios is essential and highly desirable when you want to deliver good outperformance. Over the last 10 years, you'll see that the value factor has underperformed, but a portfolio of diversified factors across all regions have still done well. And a lot of other factors have come up, have sort of supported that underperformance of value. Again, diversification is key here. But just building a historical track record using empirical price data to deliver a portfolio is sort of fraught. The reason is prices of securities are quite volatile. So it's really easy to create back tests that actually outperform. So in this case, it's really important to figure out what the theoretical underpinning or the reason why each of these factors outperform. If you can't find the reason, then it's probably data mined. So looking at the economic mechanisms of asset pricing, there's two major themes. The first one is risk-based, and then the second one is mispricing-based. What I mean by risk-based is general economic theory tells us that if a stock has a higher risk and a higher undiversifiable risk, then it should give you a higher return. And when we look into these particular models, there is a lot that can be said about all of these factors and why they should and do deliver you a long-term outperformance. The two general equilibrium model extractions we can get are the consumption CAPM, why a set of securities should outperform because their correlation to consumption is higher. And then the second one, and a much more recent addition you'll see, is the investment CAPM. The investment CAPM came around from work that's been done in corporate finance. They've been using these sort of rules for a long time. And it's only recently, as you'll see in the last 10 years or so, that we're able to extend this type of logical argument into asset pricing models. The second one here is behavioral finance models, or the mispricing. What these say is that we are irrational under some general view of the world, but we're predictably irrational. And that irrationality creates mispricings. And if we take advantage of those mispricings, we'll have a portfolio that will outperform. Okay, so under economic general equilibrium models, the simplest form of this is that there are four agents. The first one is we have firms. Those firms pay wages to workers. Those workers pay income to households. Those households expend and consume by buying things in product markets. And the product markets provide revenue for the goods that are sold to the firms that produce them. This is a very simple model, and it is extended with various other parties when the need arises. For example, if we're looking at currency or global trade, we'd want to put foreign economies into this model. If we're looking at tax or redistribution, we'd want to put governments in this model and create ways and expectations about what would happen. In this case, we're actually going to put the financial markets into this just simple model. And what we see is when we add finance markets to this model, households have a choice. Rather than just spending all their income on consumption in any time period, they can choose to actually save some. And when they save some of that money, they will be able to consume more later. Financial markets will invest, and they'll invest monies into firms, and those firms themselves will have choices. And one of their choices is, should they produce the consumption good, manufacture that consumption good, or should they manufacture a little bit less and invest in forward future higher production? Optimizing households and optimizing firms lead to the consumption CAPM and lead to the investment CAPM. So let's look at the consumption CAPM first, which is, as I said, households deciding how much am I going to consume today and how much am I going to delay consumption, invest that money, and require a higher return for future consumption. So what we see is that investors actually distinguish between good times and bad times. And that is good times for them and bad times for them. Good times for them is when they are earning a lot of money and when the marginal utility of consumption is low because the consumption level is quite high. And this just comes from the basic idea that a utility curve is concave. That means for every additional dollar you earn, your enjoyment is slightly less than the previous dollar. It also means that when you have a lot of consumption, you get a little bit less out of the extra dollar. And when you have very low consumption, which usually occurs in bad times during recessions, when people lose their job, an extra dollar then is very valuable. So any asset that has a low payoff in bad times, they don't give you that extra dollar. Lower prices occur and higher expected returns going forward result. So if I say that in the opposite way, any asset that pays off well in bad times and less well in good times is highly desirable. And that product will have, that company will have higher prices and therefore lower forward returns. The mathematics, and I'll stay away from a lot of mathematics, but the mathematics of that just say the beta of a company that matters is that beta to changes in consumption. We're really familiar with calculating the beta to changes in equity markets. And we know that the equity market goes up during good times and down during bad times, but it doesn't do it perfectly. And there is additional risk that people face. If we could calculate the beta of every company to consumption, then factors probably wouldn't exist. And CAPM in its very simplest form would hold. So if we actually try and measure this beta, so there was a great paper by Ball 2022 that actually looked at annual changes in profit levels of companies against total factor productivity, which is a good measure of the available consumption for households. And you compared that to the average company. The average company had a positive beta, so it's riskier because it does well in good times and it actually doesn't do that well in bad times. But if we go and calculate the beta of these other factor portfolios, so here we've got the book to market spread. So what we're talking about here is companies with high book to market, we buy, and companies with low book to market, we sell. That portfolio of companies has a much higher beta than the average. And in a way, those companies will have not only the market, but also that spread on top. So that much higher beta to consumption cycle means that those companies should and do have a higher compensation. You'll see across the spectrum here, small size also have a higher beta, momentum spread also has a higher beta, and investment spread, low investment companies also have a higher beta. So in terms of consumption and correlation to consumption, 4 of these factor portfolios have higher beta and therefore should be compensated higher as a direct result. Second economic justification for factor portfolios comes from the investment CAPM. So really what we're doing here is looking at companies and saying, what should the behavior of companies be and what can we understand from that? So the first thing here is that firms target maximum share price. Sometimes we don't really think about this when we're investing because we think about companies want to maximize return. Actually, what they're trying to do is maximize their share price. That will maximize the return to get there, but that's what they're looking for. And to do that, there are 4 measures that we are interested in. The first one is firm profitability, how profitable the firm is. Also, the volume of investment, so how much investment they make. Their volume of productive capital, what's in place that they can actually generate return from. And then the adjustment cost multiplier. Now, the adjustment cost multiplier, I always think about in terms of the fact that if I'm doing renovations on my house, during a good period of time, during a economic expansion, it's really hard and much more expensive to get a builder because they're all busy doing jobs. During a bad time, it's much easier because there are a lot more of them who don't have jobs. So the adjustment cost multiplier varies with time, and the variation tends to be it costs more in good times and less in bad times to actually invest. So from something that's very related to the Q theory of investing from corporate finance, we will see that firms will invest until the marginal return on their extra dollar is equal to the cost of investing. So as they invest more, their cost of investing will rise. It's harder to find good investments to make, so the actual return from those investments will fall. And firms who are acting optimally will invest until they are equal. So I'll actually here look at 3 examples and why 3-factor portfolios end up delivering higher returns based on this particular equation. So what we look at here is the return of a company, of investments in that company, is proportional to profit over essentially the cost of that profit. So if we sort all companies by profit, what we'll see is companies that, because they've got higher profitability, they have invested less than other firms. They have stopped investing earlier because they have a higher cost of investing, a higher weighted average cost of capital. So really what we're doing in sorting by high profitability companies is looking for companies that are riskier because they have and have been deemed to have a higher cost of investing. Second one here is low investment. So what you're looking here is, rather than maximizing that equation on the top, we're actually minimizing the equation on the bottom. And to minimize the amount investing, and that's what we do here in building a low investment portfolio, we're looking at companies that stopped investing earlier because they ran out of profitable opportunities compared to their weighted average cost of capital. Both high profitability and low investment factors are looking for the same thing, but they're doing it by looking through a window into a different window in a house and getting a different view on the investment universe. The third one here is the high book value to market, or the value factor. And what happens here is it really depends on the difference in the adjustment cost multiplier during growth periods and recessions. So if you have a company that has a lot of in-place assets, they've invested a lot historically, their future growth and future profitability has very much been locked into that fixed asset base. And if a recession or a bad time comes around, they usually have to sell some of their in-place assets to pay for and make sure that they avoid bankruptcy. In selling some of their in-place assets, they do that at a lower cost or a lower price than they bought it. And as a result, they underperform quite substantially. Over the long term, they need to have a higher return because this is a risk that comes about during bad times. So you'll see for the last two sections there, when I talk about both the investment CAPM and the consumption CAPM, we are really looking at that equilibrium pricing model. And riskier firms have a lower price, and a lower price leads to higher returns. Within behavioral finance, that has sort of been built and discussed alongside that risk approach. It's very much viewed as a mispricing approach to factor investing. And what we say here is there's a few different irrational or behavioral biases that we have as humans, and these lead to predictable portfolios that will outperform. What we have here is anchoring, conservatism, and representative heuristic. So anchoring is the very first piece of information we get on something, we tend to anchor on that. We take it in and give a lot of weight. We say, that's the first idea I heard. I'm going to assume that that is right. Conservatism is when we're presented with new information, we tend to revise our beliefs quite slowly. And tests and studies around how people adjust their beliefs shows that we actually value new information about half the value that it has. So we actually have quite a slow updating. These anchoring and conservatisms lead to over and underreaction of news. They lead to holding losers and selling winners early. And they support a lot of these factor portfolios such as momentum. The last one is the representative heuristic, and we'll see this everywhere. So not only in terms of sort of investing and factors, a representative heuristic means that we tend to simplify by bundling similar things together. So rather than seeing exactly what we have, we tend to represent something in a very simple way. And something that I see quite a lot within the representative heuristic is that investors mistake a good company for a good investment. They tend to think a good company, which is usually lower risk, will lead to a higher return, where in a sense, it actually leads to a lower return because it's less risky. All of these characteristics would disappear quite quickly if we could arbitrage them. If there was no limits to arbitrage, you could then have a few players, usually large investment banks could come in and they could trade against these behavioral finance quirks and take all the profits for themselves. But the reality is within markets, there is a lot of limits to arbitrage. So even when they're known, they will persist. So what's important for us here is when we look at factors, not only should they have very good empirical justification, it should be there in the data. You should have independent verification of that. They should also have good outer sample performance. So after it was found and published, it should be able to produce a return rather than just being data mined. And it also should have this economic justification. And you'll see across the board for these 6 factors, they not only have one, but they often have 2 or 3 reasons why they should deliver a return. It's important that that's there because otherwise we can use that very high volatility, the very depth of data we have in prices to be able to produce significant number of portfolios that will outperform in sample, but out of sample they won't deliver. So having gone through all that, the what, as I've said, and the why, I'll turn it over to Felix, who will really give us an idea of what do we do with this and how can we use this information in building multi-factor portfolios and as well as just investing in general. So thank you.
Thank you, Mike, and good afternoon. So we are seeing recently, a lot of initiatives from providers of factor investing products, and a lot of these initiatives are around innovation in the factors that they're using, and I'm really talking here about kind of traditional equity investing, and so of course there's a separate question that providers sometimes try to push the concept of factor investing to kind of entirely new asset classes, but even in the mainstream equity investing, we see recent claims of what people call next generation factors. So almost all of the main providers currently will have claims of next generation factor innovation. And so they claim that they've basically discovered these new factors that will bring benefits to investors. And so the question that arises for investors is really, well, what about these next generation factors? Why should they actually bring benefits to me, and how do they really relate to kind of the basic requirements that we have for factors? I think that's always an important question to keep in mind, is really to go back to the basics and ask, well, what are actually the key features of a factor? How should people go about identifying these factors? And then, when I apply all of these criteria, what can I say about these next generation factors? Now, these new innovative factors, I'll just give you a few examples here. This is really just from, some recent material that was published, and this is these are kind of factors that you find just really across kind of the main factor providers. And so you see these examples here. So one provider actually has introduced an innovation factor. So, targeting companies that have more, capacity to create new products, to do successful research and development, etc. So an innovation factor, and the claim here is that leads to a substantial outperformance. Some others are around, things like energy efficiency. Lots of them also are related to sustainability themes. So one kind of popular approach now is to go to, a typical quality factor, which usually centers around, things like profitability and some measures of balance sheet strength, and now to add kind of ESG quality to this quality factor. So things like environmental friendly companies, or companies with good corporate culture. These kind of new criteria will create some new kind of quality factors. You also have one provider that has introduced what they call a machine learning factor. Now this is somewhat interesting because, of course, machine learning is actually kind of a whole set of techniques that you can apply to, in principle, extract all kinds of factors. So it does seem a bit surprising of what the machine learning factor per se is. If you look at it, machine learning could maybe help you to identify a factor. It doesn't seem to be something that per se is a factor. But you can see from these examples that a lot of these new factors, they actually are motivated by some new data sources or new considerations, typically a sustainability consideration. So relatively few of these factors will just go to balance sheet data or returns data, along the lines of what we've seen for the traditional 6 factors, and then make some tweaks to that. But a lot of these factors will actually kind of go to new data sources, look at sustainability data, and quite often providers justify these new factors also with new data that they have. So say we're just using these new data to come up with new factors. One of them, which is also interesting, which I find interesting, is that one of the major companies in this sector has actually come up with a war veterans factor. So they argue that US companies that employ war veterans, that reflects kind of social responsibility, and kind of there's an alpha to investing in companies that employ a lot of war veterans. So what should investors make out of all these novel so-called next generation factors? Well, what I would argue is that, of course, you cannot dismiss these factors from the outset. You also shouldn't be excited by them just because they're new, right? So they could be new and not reliable. They could be new and could actually be meaningful. So novelty per se shouldn't really be a relevant criterion. So basically, you should just evaluate these factors as an investor, as you would any kind of investment proposition, and any factor. And so we do have a well-established series of criteria, really, that we typically apply to factors. So they should be plausible in terms of having an economic rationale. They should also be pervasive. So hopefully there's not just one backtest, but there's just lots of evidence in different markets across asset classes that these are actually relevant factors. So this is actually really key. And maybe most importantly, these factors, they should also be, if you will, persistent or robust. So basically, you don't want to invest in a factor that looks good, but then once people start investing in it, that outperformance actually disappears, right? So in other words, you need to make sure that these factors are also reliable. Now, I will show that, some of these new factors, they're probably, mostly about showing nice backtests. And of course, if you talk about new data sets, you're basically allowing yourself a lot of flexibility, right? Because there's so many new data sets, and you can always use these data sets to create an attractive backtest. Some of these innovations also could be much more positive. They could actually be about improving the measurement, right? So we have a set of factors. There's an economic rationale as to why certain factors should carry a reward, but there isn't, anyone who can tell you that they can perfectly measure, what the value factor is, what the investment factor is. And so maybe improving measurement is actually a good way forward. And if you have some, economic logic as to why it's better to measure a certain factor in a new way, that's probably something that, you can trust in more. It's probably not just about inflating a backtest. So I'll just discuss some examples of things that you can do to simply inflate backtests and things that you can do to actually improve your measurement of a factor. And then I will just conclude with some kind of safeguards, kind of a checklist for investors. What do you actually have to ask your factor provider when that provider comes to you with, his list of factors or his kind of new factor discoveries? How to make sure that, you're actually these factors are actually reliable. So what can we say about some of these factor innovation? Some of this factor innovation really looks very surprising. So you see some claims of novel factors, where actually, of course you could say, these claims, they might have to be, tested more in the future, etc. And so we, might have to be a bit careful with just provider-specific results. And I'll give you an example here of this innovation factor. So the one provider came up with a factor discovery, which they call the innovation factor. And the way they measure innovation in companies is simply by the research and development expenditure, relative to the revenue of the company. So if there's lots of R&D expenditure relative to the sales in the company, that's a very, innovation, if you will, R&D intense company. And so this provider argues that tilting to these high R&D to revenue companies leads to an outperformance of something like, almost 6% per year. So the question then you might have is, well, is that actually, is that actually a robust result? And it turns out you don't actually have to go and employ researchers to answer this question, because this question has already been answered in the academic literature, and actually it has already been answered more than a decade ago. So if you look at the return effects of R&D to revenue, people have actually studied this in long-term US data. And you can basically see that there is no effect, right? So there's this is from a recent paper that basically looked at a lot of the different factors that have been studied in the literature. And what you show here is the effect that they measure for R&D to revenue. You see here there's different ways of measuring this effect. So with cap weighting, equal weighting, and this return effect here, which is a monthly effect, is estimated to be somewhere between a -4 to a -8 basis point per month. That's not statistically significant. So there is basically no effect. So it does seem surprising that a provider in this in the asset management industry basically goes out and says, hey, I found this new factor, R&D to revenue, where if you simply look at the literature, you can already see that different studies have actually shown that there is no such factor. And what explains the difference in results is simply that the literature looks at long-term data. And here, as you can see in the claim, this provider basically looks at a backtest over the past decade. And of course, you cannot conclude much on kind of long-term expected returns and existence of factors from looking at one decade. So this is just an example, basically showing that some providers probably are quick to come up with new factors, and that includes even factors that have already been shown to not actually exist in the academic literature. So basically quite often, and in this case, you're just coming up with a backtest that looks good but is not reliable. Now, another popular I think activity in among factor providers is to use this sustainability data that we have to come up with some novel factors. So if you think about social, environmental characteristics of companies, of course you're facing a vast choice of possible characteristics that you can use, and so this will always allow you to pick some characteristic that actually led to favorable performance in a given sample. And so here, this is not a kind of a serious analysis. So I'm just, putting myself in the shoes of someone who wants to create an inflated backtest. I have access to a, database with ESG data. And so we came up with this factor. So we call this a BioAlpha Plus factor. We're looking at a stock's natural capital rating. So basically the idea here would be that, some companies, they are actually more wise in their use of natural resources, and we want to tilt to these companies. So we create a factor that tilt to these companies, and we just position ourselves here also in a favorable time period, which is relatively short, and we can see that we extract about a 5% return out of this factor. So the Sharpe ratio is 0.8. This is clearly much larger than, for example, the Sharpe ratio of a typical value factor over a very long period. So it seems that we're really onto something here with our natural resource factor. And the typical kind of claims that you will hear from providers is that, well, maybe companies that are more wise in the use of natural resources, they might face less regulatory risk, and basically it might be easier for them to obtain higher profitability because of their smart use of resources, and maybe the market is just not kind of smart enough to price all this in, and so that's maybe why when you discover this slowly, investors who are actually investing in these companies, they actually get this alpha from investing in these companies. Now, to look at this a little bit differently, though, you can easily see that this kind of strategy doesn't reliably actually produce any meaningful outperformance. And so you looked at this result previously that we had, so roughly 5% annualized outperformance, and we can claim that we found this new factor. So what we do now is we change the view in two ways. So the first change we make is we now look at the value added over and above these workhorse factors, right? So these 6 factors: value, profitability, momentum, etc. Instead of simply looking at the raw returns, right? So it might be that tilting towards these environmental friendly companies actually just implicitly gives us some exposure to, say, quality companies, high profitability companies, etc. So if that's the case for a factor investor, well, if you already have access to these factors, you're not actually getting any benefits from tilting to these companies. So instead of looking at raw returns, we look at value added measured over these existing 6 factors. And so in a way, we're adjusting for the exposure that these supposedly new factors have to the already existing factors. So that's the first change in perspective. second change in perspective here is, well, we're looking now at 25 possible sustainability factors. So before that, I just showed you one. I didn't really explain to you where this came from. I just gave you some anecdote of why this could work, but I didn't actually show you the entire set of possibilities that we've actually tried. So here I'm showing you all the possibilities that we tried, and these are 25 sustainability characteristics. Where do they come from? Well, they just come from looking at 3 different ESG rating providers, and then looking at the different themes that these rating providers cover. So what I called these BioAlpha Plus was just a natural capital rating, which is provided by, as part of the MSCI ESG ratings. So let's look at what happens when you change perspective. So already you can see the value added here of this natural capital rating. Well, it's not 5% as the raw return, it's now 1.5%. And this 1.5%, it doesn't have any statistical significance, right? So even you do get a slight value added, positive value added in the sample, it's not high enough to basically be meaningful. And you couldn't conclude that there's actually any real effect within that sample that you're observing. And so that's the first important change. You're going from this pretty spectacular 5%, you're going to only 1.5%, which is not even statistically significant. More importantly, though, you see what happens when you consider these 25 different sustainability factors. And some of them are very similar to this natural capital rating. And across these 25, there is clearly no value added. So if you take the average across these 25, the value added is actually a negative 1.7%, right? So if my story about somehow firms can avoid regulatory risk, and the market doesn't really yet know about this, and so you're getting some outperformance, well, that shouldn't just apply to the MSCI rating on natural capital, right? The same should apply on basically any of these ESG characteristics. And so if I believe in this explanation, I would expect that on average there should be some value added, but you can actually see that there is none on average. Even I think more interestingly, you have some ESG characteristics that are very much related to this MSCI natural capital rating. So, for example, you have something called resource use, which is provided by Refinitiv. Also, you have something called waste management. And of course, that's very similar to this idea that companies that manage their waste responsibly, or that make good use of resources, well, that's kind of very similar to this natural capital rating. And these are indicated here in green. So you can see that these waste management and resource use scores, if you tilt to them, they actually don't lead to any value added either. Okay, so basically this finding that we showed, and this nice factor that looked so nice in the graph, it's basically something that you can just come up with by picking carefully after having selected 25 different sustainability metrics, and also forgetting to adjust for any other factors, so you can show some outperformance, but actually there's really nothing that investors should seriously consider when you look at this entire assessment. So just a simple example to show you that it's kind of easy to actually play with these new data sets and come up with new factors that, however, don't withstand any kind of even basic, very basic scrutiny. So, it doesn't mean that all of these factors are necessarily just cooking up some inflated backtests, or isn't there something reasonable that people try to do when they come up with new factors? Well, I would argue one of the really kind of interesting avenues when thinking about factors is really to think about improving the measurement. So the benefit of these standard factors is clearly that they have a strong economic rationale. So you have a economic mechanism behind this, like profitability, investment. You also have this mechanism behind the value factor, which is quite well known. And so the question then remains in practice, well, how do you actually measure these factors? And in the case of the value factor, one of the common criticisms that people have made is that if you look at the book to market ratio, you're actually ignoring any intangible assets, right? So the standard definition of book value, or how it's actually measured in accounting, actually ignores most intangible assets. So the question is, can we do better than that? And there are several studies that propose to include intangible capital in the book value. So you can come up with an adjusted book to market that actually adds back these intangible assets. How do you do that? Well, you actually have to estimate the intangible capital. You can do that by the items that are expensed. So, for example, you have knowledge capital. The knowledge capital is basically what's made up of the investment into research and development. So you do have information on these expenses, and you can then just basically capitalize these expenses. You also have organization capital. So organization capital, you can think of a professional services firm, a strategy consultant, for example. Their value typically is made up quite substantially from the network that they have, the relations that they have, the training also that they've put into their consultants, etc. And this is typical organization capital. Now, this also you can see what are actually the kind of general expenses that this firm actually undertakes, and then you actually basically can basically estimate that these are investments into organizational capital, so you can account for organization capital. So this is something that's been done in the literature. We've published a paper on this, and what you can see is that adjusting the book to market in that way actually kind of improves the value premium. So you get a kind of much more substantial and reliable premium out of the value factor. And what you can also show is that this is actually a kind of a much more efficient way of defining the value factor than trying out different kinds of ratios, like moving away from book to price and going to things like earnings to price, cash flow to price, which is quite popular. So here what you can see is what is the value added over existing factors when you actually adjust the book to price. So this is this I book to price, and so intangible adjusted book to price. So you can see substantial value added over the other factors. If, on the other hand, you simply combine different accounting ratios, as is popular, so you look at things like earnings to price, dividend to price, you create a composite. You have that on the right-hand side. You basically don't get any value added over the other factors. So empirically improving the measurement clearly helps. There's a simple explanation also of why this helps. This helps because you're really getting returns that are not explained by exposure to the other factors. So what you see here is this adjusted return of the value factor. You can see that that's very strong for the intangible adjusted value factor. However, it's quite weak, as we've seen before, for these composite metrics that are popular in the industry. And you can see here the reason. So the blue bar shows the exposure to the profitability factor. Now, adjusting the book to price for intangible capital doesn't actually give you any exposure to the profitability factor. So basically, you're just getting value exposure. So you're not getting kind of unintended exposure to profitability. If you're using these popular composite metrics that combine things like cash flow to price, earnings to price, etc., you're actually getting substantial exposure to high profitability. And this is not a surprise. So if you look at firms with high earnings, high cash flow relative to the price, that's typically related to the fact that they are highly profitable firms. And so kind of mechanically, by moving away from the standard book to price to these composite ratios, you're getting some profitability exposure, which means you're actually not creating a better value factor. You're just creating a mix of factors, and you're actually not adding any value. However, improving the measurement and bringing in the intangible capital actually improves the value factor. So and this is not based on a back test. I mean, this is a kind of long-term data, but also there's a strong economic rationale behind doing this. It's basically the standard rationale for the value factor, and then just accepting that in today's economy, intangible capital is just part of firms' assets, and so we should account for it. So I think you can see that I don't think factors should be judged on the basis of whether they are innovative or not innovative. I find it sometimes surprising that there's so much talk about and excitement about these next generation factors, because just being new, of course, doesn't really help investors, getting any benefit out of investing in new factors per se. Instead, investors should ask, what are really the inherent qualities of these factors, whether they are standard factors or next generation factors. And I think what I tried to show is that these new factors can be quite different in nature. Some of them might simply be ways of inflating backtests. Others might actually lead to some real improvements in terms of measurement. So investors should really be careful when they're presented with any factors. And I think they should ask some tough questions to their providers of factor products. And essentially what they should do is they should just ensure that, they're not accepting, easily these backtested performances, but they should basically, apply some hurdles to these factors. And here's a common kind of checklist. So some of the hurdles that investors should ask their provider about, and I'll just go through them very briefly. So the first one is very, basic. It's just asking, well, okay, if you have a new factor or any factor, is there any external replication of that? We know that, research results might actually depend on the specific setup of the research. So, at minimum, you want to make sure that the factor you rely on is not just a finding that comes out of one particular research process or one particular provider, but it actually should hold in general. And so you should require external replication, right? Is there any, independent academic paper on this? Is there something that holds across different papers? And I think it's surprising sometimes the kind of attention that people pay to, what I call a single paper result, right? So sometimes people come out and say, oh, there's this new paper, it shows that there's a new factor. Well, that's great, but if there's just one paper claiming that there's a new factor, that's not something that necessarily is going to be reliable. There's so many examples where research results have actually been called into question after people try to replicate them, and that's not specific to finance. A second important aspect, again, quite simple, is actually the market validation. So even if the research is sound and there's strong evidence of a new factor, what happens when everyone knows about this? Right? This is a really important question. So does this actually survive reality once participants know about this? And so kind of a standard test for these factors is to look at what happens after publication. And there's lots of evidence on that for a lot of factors. Obviously, that's also a test that next generation factors should be exposed to. Another point is economic plausibility. So I already mentioned this, and of course, it's really important to check, how plausible actually is that return. And what I would just insist on is that economic plausibility doesn't just mean have some anecdote. So if you go back to my example of this bioalpha plus factor, which obviously is just a kind of a illustration, just a joke, if you will, right, showing that what people can do with data. Of course, you can say yes. Resource-wise firms, they are so much less exposed to regulatory risk, and some of the market doesn't know about this, and then this could lead to outperformance. But I can say this about anything, right? I can come up with certainly any ESG metric and say, well, maybe the market doesn't really know about this, but actually these firms, they are less exposed to some risk, and that's why they will outperform. So you should ask your provider, well, what is actually the mechanism behind that? Do you have any evidence that really the market doesn't know about this risk? Can you really show me the mechanism behind this? And I think this is where you should require a kind of a strong economic mechanism, but also some evidence that this mechanism actually exists. So I give you the example of value. So value stocks, there's some theories saying that they're more risky because that value firms have more assets in place. And well, actually, there's also some evidence that is the case. So you can see, for example, that value stocks have market betas that tend to really go up in bad times. So you can actually show that there's some evidence that this mechanism is actually at work. And for any new factor, people who promote that factor should come up with similar evidence. And then a final, perhaps obvious point is what happens when you invest in this factor with transaction costs. Does your performance still look good after transaction costs? So that's another crucial point, and that should be required of any factor. So these are just some of the, I think, questions that investors should raise with providers, and that I think will be healthy in the industry. I think we shouldn't talk so much about and shouldn't be excited about whether factors are new or next generation. The key question, I think, is robustness. And these are just some pointers how we can analyze robustness. Thank you for your attention.